In less than 24 hours, someone moved metal worth more than most nations' reserves. The price spiked, then collapsed, exactly as designed. But here's what they didn't expect. The physical market refused to follow the script. Right now, at this very moment, there are delivery requests sitting in vaults that cannot be filled, contracts that cannot be honored, and a gap widening between what the screen shows and what actually exists. This wasn't a market correction. This was a stress test, and it just revealed the fracture line in the global monetary system. What happens next depends on whether you're holding paper or metal. Welcome to Silver Radar. If you've been watching markets long enough to remember when handshakes meant something, when a man's word was his bond, then you understand why subscribing to this channel is not just about information. It's about maintaining your edge in a world where the fundamentals still matter, even when the headlines don't tell you so. Take a moment, click that subscribe button, the same way you'd mark an important document for your files, and drop a comment below. Tell us where you're watching from, whether it's your office in Singapore, your study in London, or your morning coffee spot in Dallas, because this story is unfolding globally, and your perspective adds to the analysis we're building here together. Now, let's examine exactly what happened, and more importantly, what it means for the weeks ahead. January 27th, 2026, 9:47 a.m. Eastern Time. Silver futures contracts began moving, not gradually, but violently. Within 14 minutes, the price jumped $3.20 per ounce. Trading algorithms across Wall Street flagged the anomaly immediately. Red alerts flashing on risk management screens from New York to Singapore, but by then, 1.8 billion ounces had already been transacted on paper. Let that number settle for a moment. To put that in perspective, global mining operations produce roughly 1 billion ounces annually. From every mine, every country, every extraction method combined. Someone just traded nearly 2 years of global production in under an hour. The COMEX exchange data showed unprecedented volume spikes, numbers that made veteran traders pause mid-coffee. London's LBMA reported synchronized movement, identical patterns emerging across continents. Asian markets, still open at the time, showed the same fingerprints. This wasn't organic buying pressure from retail investors waking up to opportunity. The volume signatures indicated coordinated institutional activity, the kind that requires prearranged positioning and synchronized execution across multiple time zones. Retail traders woke up to headlines screaming silver surge, their phones buzzing with price alerts. Social media erupted with speculation, forums filled with predictions of $50, $60, $100 per ounce. Financial news channels scrambled to explain the movement. Guests speculated about industrial demand, monetary crisis, inflation hedging. Then, exactly 4 hours and 12 minutes after it began, the reversal hit. Sell orders flooded every major exchange simultaneously, not gradually unwinding, but dumping. The price plummeted 480, faster than it had risen, erasing gains and pushing lower. Margin calls triggered across over-leveraged positions, automated liquidations cascading through the system, stop losses cascaded like dominoes, each triggering the next, amplifying the downward momentum. Traders who bought the breakout at $31 watched their positions implode at $26. By market close, silver had given back all gains, plus more, settling below where it started the day. Mainstream financial media declared it a speculative bubble burst. Analysts warned about the dangers of momentum trading. Commentary pieces published within hours titled Silver's False Rally and Why Retail Investors Got Burned Again. The narrative was set. Amateurs got greedy. Professionals took profits. Market returned to normal. But the data told a different story. Physical silver dealers in 3 continents reported something unusual. While paper prices crashed on exchanges, actual metal premiums were rising, not slightly, significantly. The spread between spot price and physical delivery price widened to levels not seen since March 2020. Coin shops in Texas reported waitlists forming. Bullion dealers in Germany increased premiums by 18% overnight. Asian wholesale buyers placed orders 40% above normal volumes. This divergence, this split between paper and physical, revealed the first fracture. When prices crash in healthy markets, demand decreases, premiums compress, inventory moves slowly. This market showed the opposite reaction. Lower paper prices triggered higher physical demand. Premiums expanded, inventory tightened. Professional commodity traders recognized this pattern. It's called backwardation in technical terms, but the practical meaning is simpler. People trust metal more than contracts. The 1.8 billion ounce figure wasn't just large, it was deliberately visible. Someone wanted this movement noticed, wanted the volatility recorded, wanted the system tested, and the test revealed something critical. The machinery that's supposed to connect paper prices to physical metal showed signs of malfunction, like a gauge that no longer matches the actual pressure in the tank. January 27th wasn't just another volatile trading day, it was a probe, a deliberate stress test of the global silver market's infrastructure. And what that probe revealed about the gap between claims and actual metal, about the concentration of physical supply, about the vulnerability of the entire pricing system, that's what demands attention from anyone whose business, whose wealth, whose planning depends on markets functioning as advertised. Because when the paper market and physical market start quoting different prices for the same commodity, one of them is lying, and it's never the metal. Most people think markets are simple. Buyers meet sellers, prices adjust, equilibrium achieved. That's the fairy tale. The reality looks more like a casino built on top of a warehouse, where the chips being traded upstairs outnumber the actual goods downstairs by more than 100 to 1. Welcome to the modern silver market. To understand what happened on January 27th, we must first examine the machinery that made it possible. The COMEX, the Chicago Mercantile Exchange, handles most North American silver futures trading. Here's how the magic trick works. For every actual ounce sitting in an approved vault, and the exchange allows over 100 paper contracts to be written. Each contract represents a promise, a claim, a derivative of physical metal. This system runs smoothly, as long as everyone agrees to play pretend. The moment someone breaks the unwritten rule and demands actual delivery, the machinery starts grinding. In January's delivery data showed something breaking. Delivery requests surged 340% above historical averages, not just higher, dramatically higher. Someone, or multiple coordinated entities, stopped playing the paper game. They wanted metal, bars with weight and serial numbers, not electronic settlement. The pump phase began in overnight Asian trading, precisely when Western markets slept. Large block purchases appeared across Shanghai and Hong Kong exchanges, orders sized in millions of ounces. These weren't retail-sized positions. No individual investor moves that kind of capital. The digital fingerprints showed institutional coordination, simultaneous entries across platforms, synchronized timing that doesn't happen by accident. As London opened 6 hours later, the momentum was already established. European traders saw rising prices, volume confirmation, technical breakouts on their screens. The narrative wrote itself. Silver breaking out, industrial demand surging, inflation hedge awakening. By the time New York traders arrived at their desks, the story was already trending. Financial media amplified the move. CNBC ran segments. Bloomberg terminals flashed alerts. Twitter feeds exploded with charts. This drew in the final wave. Late-stage buyers, retail traders chasing momentum, algorithms programmed to follow breakouts. Classic accumulation strategy, but reversed. Let me explain. The Hunt brothers in 1980 accumulated physical silver quietly, slowly building positions over years. They drove prices from $6 to $50 per ounce by actually removing metal from circulation until regulators changed margin requirements mid-game, essentially changing the rules to crush their position. The 2011 spike followed similar mechanics. Sustained buying, physical accumulation, price momentum. But this time, the pattern ran opposite. The spike came first, explosive and visible. The dump followed methodically, precisely timed, professionally executed. Someone wasn't accumulating, they were distributing, or more accurately, they were testing. Testing what happens when massive paper volume hits the market, testing how quickly prices can be moved, testing whether physical demand would crack under paper pressure, testing the system's ability to handle delivery requests. And here's where the architecture reveals its vulnerability. In 2011, silver peaked at $49, then collapsed to $26 within 5 weeks. Margin requirements increased, leveraged positions liquidated, paper contracts evaporated. January 2026 showed identical technical signatures, massive volume, coordinated timing, sudden violent reversal. The playbook hadn't changed, but something else had. The physical market didn't cooperate this time. Usually, when paper prices crash, physical premiums compress, dealers drop prices, inventory moves. This time, premiums expanded. Dealers reported tightening supply, wholesale buyers increased orders, the connection between paper and physical, the mechanism that's supposed to keep them aligned, showed stress fractures, like a rope bridge where some cables have snapped, still standing, but weight distributed unevenly. The 1.8 billion ounce volume wasn't random chaos, it was engineered volatility, designed to shake confidence, trigger stops, flush out weak hands. Standard market manipulation tactics, used in commodities for decades. What made this different, what makes this significant, is that it didn't work the way it used to. The paper market moved exactly as intended, but the physical market, where actual metal changes hands, where industrial users source material, where sovereign buyers accumulate reserves, that market refused the script. And when paper and physical start diverging, when the map no longer matches the territory, that's when the real story begins. Because 1.8 billion ounces of paper can be created with keystrokes. But 1.8 billion ounces of metal, that takes mines, refineries, transport, vaults, and time. And right now, someone is discovering those two things are no longer the same. 3 days after the crash, something strange started happening in Denver. A coin shop owner named Mitchell, who had been in business for 32 years, posted a sign on his door, "Silver Eagles, 6-week wait, no exceptions." Not because he was out of inventory, but because his suppliers, who'd always delivered within 48 hours, suddenly couldn't. The same day, in Munich, a wholesale dealer reported premiums jumping to 28% over spot. In Singapore, institutional buyers placed orders at 15% above market price, just to secure allocation. This wasn't panic buying. This was calculated positioning by people who understood what the numbers were really saying. While paper silver traded at official crashed prices on screens worldwide, actual metal, the kind you can weigh and stack and store, was trading in a completely different market. This divergence, this split personality in the silver market, revealed the critical fracture point. When healthy markets experience price drops, demand typically decreases. Sellers lower premiums to move inventory. Buyers wait for better prices. The system rebalances naturally, but this market showed the opposite reaction. Lower paper prices triggered higher physical demand. Premiums expanded instead of compressed. Inventory tightened instead of loosening. It's like watching a thermometer read 32 degrees, while water refuses to freeze. The instrument says one thing, reality demonstrates another. Now, let's examine who was buying while paper prices collapsed. Asian sovereign entities increased silver imports by 67% month over month. Not speculative purchases, strategic accumulation. China's Hong Kong import data, publicly available, showed the surge clearly. India's jewelry sector, which consumes 200 million ounces annually, locked in forward contracts immediately. These aren't amateurs reacting to headlines. These are supply chain managers who understand industrial reality. And industrial reality looks very different from paper market fantasy. Solar panel manufacturing alone requires 100 million ounces of silver annually. Every panel needs silver paste for conductivity. There's no substitute material at commercial scale. The solar industry is projected to double capacity by 2028. That means 200 million ounces annual demand. From one sector, non-negotiable consumption. Electronics manufacturing adds another 250 million ounces. Every smartphone, every computer, every circuit board requires silver. Medical applications consume 60 million ounces. Antibacterial properties unmatched. Military and aerospace, 30 million ounces. Strategic systems that can't risk supply interruption. These sectors don't trade silver, they consume it permanently. The metal doesn't get recycled back into investment bars. It gets embedded in products, dispersed across millions of devices, effectively removed from circulation. Now layer monetary demand on top of industrial consumption. Since 2020, major central banks expanded money supply by over 40%. The US dollar, euro, yen, pound, all inflated deliberately through policy. Currency devaluation isn't conspiracy theory. It's openly stated monetary policy. And when currencies devalue, tangible assets appreciate, not because the assets changed, but because the measuring stick shrunk. Institutional portfolio managers understand this dynamic. They're not buying silver because they love shiny metal. They're buying because it represents stored purchasing power that can't be printed. A silent shift is occurring in allocation strategies, not into cryptocurrencies, despite the media attention, into tangible assets with industrial utility and monetary history. The 1.8 billion ounce paper movement on January 27th wasn't the real story. It was a symptom, a visible manifestation of deeper structural stress. What that event actually revealed was capacity limitation. The probe tested whether the system could handle large delivery requests, and the answer came back in tightening premiums, in lengthening wait times, in geographic arbitrage opportunities. Vault inventory data from London, the historic heart of global silver trading, showed an 18% decline over 6 weeks. The metal is physically moving, flowing east, toward economies that produce goods rather than print currencies. And here's the critical observation. That metal isn't coming back. When silver moves from London vaults to Shanghai, from New York to Singapore, from Western financial centers to Eastern manufacturing hubs, it's not a round trip. It's a one-way journey toward consumption, toward solar panels being installed, toward electronics being manufactured, toward strategic reserves being accumulated. The paper market can create infinite contracts, but the physical market operates under different laws. Laws of geology, mining capacity, refining throughput, transportation logistics, and those laws don't care about margin requirements or trading algorithms. January 27th exposed the gap between paper promises and physical reality, a gap that's widening, a fracture that's spreading. And the question business leaders must now answer: which side of that fracture do your assets sit on? There's a moment in every market cycle when the smart money moves quietly, while everyone else is still debating whether anything changed. That moment is now. For business leaders watching this unfold, the question isn't whether the silver market has structural problems. The data already answered that. The question is, what does this mean for your operation, your treasury, your competitive position in the months ahead? Let's start with the supply chain assessment. First question: does your business depend on silver in any capacity? If you manufacture electronics, medical devices, solar components, automotive sensors, the answer is yes. And that means you're exposed, not to price volatility, that's manageable, but to supply interruption, which isn't. When premiums hit 30% over spot, when delivery times extend to 8 weeks, when suppliers start allocating rather than fulfilling, your production schedule becomes someone else's decision. Second question: are your treasury reserves entirely paper-based? Cash in bank accounts, bonds and portfolios, equities and retirement plans? All of these share one characteristic: counterparty dependency. Your cash depends on bank solvency. Your bonds depend on government creditworthiness. Your stocks depend on corporate performance and market liquidity. Each layer adds another promise, another link in a chain of trust. Physical assets eliminate that chain. A bar of silver in allocated storage doesn't depend on anyone's promise. It exists. It has weight. It has utility, independent of any institution's balance sheet. This isn't speculation. It's balance sheet risk management, the kind taught in business schools before financial engineering became the dominant paradigm. Now, let's discuss forward purchasing strategy. If your operation consumes silver, the time to lock in supply contracts is before premiums widen further. Industrial buyers who secured forward contracts in early January locked in prices 22% below current procurement costs. That's not market timing, that's operational prudence. Consider diversifying storage across jurisdictions. Singapore offers legal clarity and political stability. Switzerland provides historic neutrality and vault infrastructure. Canada combines proximity to U.S. markets with separate legal framework. Each jurisdiction offers different advantages, different risk profiles. Geographic diversification isn't paranoia. It's recognizing that regulatory environments can change rapidly. Ask anyone who held gold in U.S. banks when Executive Order 6102 was signed in 1933. Verify your holdings through independent audits. If you're holding silver through an ETF or certificate program, understand the difference between allocated and unallocated storage. Allocated means specific bars with serial numbers assigned to you. Unallocated means you own a share of a pool alongside other claimants. In times of stress, that distinction becomes critical. The case of MF Global in 2011 demonstrated how customer-segregated accounts, supposedly protected, became entangled in bankruptcy proceedings. Paper claims don't always equal physical access. Now, the broader strategic context: generational wealth requires assets that survive system resets. Throughout history, through currency collapses, regime changes, financial crises, what retains value? Things that are scarce, useful, and can't be created by decree: agricultural land, productive businesses, strategic commodities. What loses value? Promises, certificates, claims, anything requiring institutional performance to maintain worth. The 1.8 billion ounce pump and dump on January 27th wasn't the headline. The headline is what happened after. The refusal of physical markets to follow paper prices downward, the expansion of premiums despite collapsing spot prices, the acceleration of eastward metal flows, the lengthening delivery times at wholesale level. That divergence between paper and physical is the signal. And signals like this don't issue repeated warnings. They appear once, briefly, for those paying attention. Then the window closes. Think of it like a stress crack in a dam. Initially small, easy to dismiss, explained away by engineers, until it isn't. The question facing business leaders isn't whether you believe this analysis. Markets don't care about belief. The question is, can you afford to ignore it? Can your supply chain handle 8-week delivery delays? Can your treasury withstand a 30% premium environment? Can your competitive position survive if your rivals secure supply while you're still debating? Because while you're running scenario analysis, others are making decisions, locking in contracts, diversifying holdings, eliminating counterparty risk. The advantage goes not to those with the most complex models, but to those who recognize structural shifts early and act decisively. January 27th, 2026. marked a turning point. Not because of what happened that day, but because of what it revealed about the system underneath. A system where paper claims far exceed physical supply, where delivery requests trigger premium expansion, where the gap between screen prices and real prices widens daily. The strategic response isn't complicated. Assess exposure, secure supply, diversify holdings, verify claims, eliminate counterparty risk. Simple, but not easy, because it requires acknowledging that the map we've been using no longer matches the territory, and in markets, as in navigation, using the wrong map is more dangerous than having no map at all.